Hello everyone, welcome to this video how to value a stock using intrinsic valuation part 3rd. In the previous two videos, we discussed about the concept of intrinsic valuation. We gave a brief introduction of what exactly do we mean by intrinsic valuation, how do we calculate intrinsic value of a stock by showing a formula, and then we also discussed about why valuing an asset using a typical conventional approach, that is either using a PE or a price to book value, how it can be misleading, how the stock, if valued on a EPS or a net profit, or as I said PE, can give us may not reveal the true picture of a particular stock. Then we also discussed about the different types of financial statements that we encounter while we are analyzing any company. So basically we have, again, just to summarize, we have three types of financial statements. That is balance sheet, which basically talks about the different types of assets and how those assets have been funded. So basically it talks about the assets, liabilities, and shareholders equity. Then the second statement is profit and loss statement, wherein we talk about the sales, revenues, operating profits, operating profit margins, and profit before tax, profit after tax, and things like that. And then finally we come to the most important part of or we can say equally important, cash flow statement analysis, wherein again these are divided into three categories. That is cash flow from operating activities, cash flow from investing activities, and cash flow from financing activities. So basically we have seen that how do we calculate a typical free cash flow of a company by subtracting the cash flow from operations, and from cash flow from operations we subtract the capital expenditure that the company has planned, or that the company is basically doing. So these were few of the different types of financial statements that we discussed. And then we also discussed about the few key terms that are basically involved in calculating intrinsic value of a stock. So we discussed about concepts like a risk-free rate, basically, which is nothing but the yield on a typical 10-year or 30 years government securities. And then we also discussed about the equity risk premium, that is nothing but the premium that the investors are looking for while investing in equities, because as we know that investing in equities is not a risk free environment. So basically we have to, so investors look for a premium to compensate that additional risk that they are taking. So that was equity risk premium. And then we also discussed about something called capital asset pricing model, or CAPM in short, wherein we try to calculate a statistic called something called beta, which is basically nothing but the volatility of a stock, how a stock is performed with respect to the entire market, or with respect to the benchmark that we have taken for that stock. And if that beta value is less than 1, then we say that the stock is not much volatile, and if it is more than 1, then we say that the stock is volatile than the market. And then subsequently we also calculated something called cost of capital, which is again further divided into two parts, depending upon whether are we valuing the entire firm or are we valuing just the equity part of it. So when we are trying to value the entire firm, so we call it as a weighted average cost of capital, or a WACC. And if we just try to value the stock or the equity part of a company, then we call it as a cost of equity. And then we also discuss that how the two cost of capital are derived. They were using the formula and all. And then in the end, we also discussed about the two approaches for intrinsic valuation. And as I mentioned, any approach using a DCF, that is discounted cash flow method, it can be done from two perspectives, either by valuing the entire company, or which is also called as fair enterprise valuation, or we can just value the equity part of a company, which is called a equity valuation. So in this part, that is part 3 of this, we are going to cover the various, what are the various inputs that are, so we are getting, now we are going into the, into the nitty gritties of how do we actually calculate the intrinsic value of a stock. So we'll consider a fictitious company called ABC, and we'll try to calculate its intrinsic value. So what are the various inputs that are required for calculating the intrinsic value of a stock will be the first point that we are going to discuss. And then we are also going to discuss each of these inputs which are required for calculating intrinsic value. And then finally we'll arrive at how do we calculate intrinsic value, and if at all it requires some sort of polishing by considering some other qualitative factors like management and all, and so on and so forth. And then finally we'll also discuss the various drawbacks when we are doing intrinsic valuation calculation using CAPM, and why and how the world's greatest investors leverage this DCF method. So we'll be discussing all those things in the conclusion slide. So guys, let's get started. So as I mentioned, the first point would be what are the different inputs which are required for calculating intrinsic value of a stock. So basically, if you ask me, so only four inputs are required if I have to calculate intrinsic value of a stock, which are further categorized into whether are we trying to value the entire firm, which is called fair enterprise valuation, or are we just trying to value the equity part of the firm, which is called equity valuation. So the first input is called cash flows from the assets. Second input is called expected growth in these cash flows. Third is called the risk in the cash flows, and the fourth one is called the terminal value. And as I said, all these things can be further, looked upon whether we are trying to value the equity or the enterprise firm. So in detail, we'll be talking about. So first, we'll be talking about the what are the cash flows that we expect from the assets, or what are the cash flows that we expect from the company. The second point would be how do we foresee the growth in these cash flows. So do we foresee any growth in the cash flows? So how do we arrive at that growth number? So that would be the second input. Third is what is risk in those cash flows. And as I said, if and since we know that DCF method is very much suited for companies which have stable and consistent cash flows. So we'll see in this case that what is the risk that we are foreseeing in these cash flows. Are those cash flows which we are trying to factor in, will they actually arrive at the desired point of time, and how do we compensate for that additional risk is something that we are going to talk in risk and cash flows. And at the last is called terminal value. So as I mentioned in my previous videos as well, that terminal value is nothing but so usually in DCF what we do is we try to calculate cash flows up to a certain period, which is usually 5 to 10 years, and then post that we try to fix a value to that company, which is which takes care of its value. So it is called terminal value. So basically, again in this case, there are two approaches. One is the liquidation value, and the second one is the going concern. So liquidation value means that if suppose after 5 years or 10 years, till the time we are once the forecast period is over, so there are two things: either we can liquidate the company and get back whatever the proceeds we are getting from that, or we can also or in majority of the cases what happens is the company doesn't get liquidated and it sorts of continue over next 20, 25, 30 years, and so on and so forth. So we'll now discuss each of these inputs in detail. So the first one is cash flow from assets. And as I mentioned, there are basically two types of cash flows, again depending upon what we are trying to value. So in the previous videos we have discussed about what is free cash flow to equity, and so I've just mentioned it for our reference, that what is meant by FCFE and what is meant by FCFF. So FCFE, as we discussed in our previous video, that basically it is nothing but we are trying to rationalize the net income with the true reality, or basically the aligning the net income with the actual cash inflow or cash outflow. So what we are basically doing is we are adding back the all the accounting expenses but not the real expenses, and those are the ones which are highlighted in yellow, that is depreciation and amortization. And we are subtracting the actual expenses but then which are not a part of accounting expenses, right? So to sum it up, FCFE or free cash flow to equity is nothing but net income plus depreciation amortization minus increase in working capital and capex. And then if a company has taken any debt, then that also is added back, and then principal repaid is subtracted from it. And what basically Warren Buffett looks for is called owner's earnings. So wherein he discards the last two terms, that is the net debt and principal repaid. So basically what owner's earnings is nothing but net income plus depreciation amortization minus increase in working capital and capex. So that is the typical formula of an owner's earnings. And in this example also, we'll try to limit ourselves to FCFE by discarding the last two terms, that is net debt and principal repaid. And the second type of cash flow, which basically takes care of all the sources who are providing a capital to a firm. So basically, herein we'll also include cash flows which are to which the creditors and equity investors both are entitled. So in the first FCFE, cash flows are basically these are the cash flows to which equity investors are entitled to. For FCFF, all these sources, so that the banks or people who are investing in the bonds of a company, so all these people who providing capital to the company, they are basically a part of this FCFF. And how it is calculated is by adding after tax operating income, and by adding depreciation amortization, and reducing again, or maybe subtracting this increasing capital, working capital and capital expenditure. So it is more or less same. Only thing is that in FCFE we are talking where we are rationalizing the net income, which is to which the equity investors are entitled to, and in FCFF we are rationalizing the after tax operating income, because this is the capital to which all sources of providers of capital are entitled to, right? So what we'll do is, for the third point, we are trying to value a company, again a fictitious company called ABC, wherein we are trying to do a equity valuation as well as an enterprise valuation for this particular company. So these are few of the hypothetical cases, or maybe some parameters that I have listed it down. So let's say we have a company which has the following parameters. So in that case, how do we calculate FCFF is, so basically the parameters are like, let's imagine that a company has an operating after tax operating income of 4,000 crores, and a depreciation of 300 crores, and capital expenditure is 1100 crores, and increase in working capital of 250 crores. So as per the formula which I have written above, so basically how the FCFF of a company can be determined is that we take the after tax operating income and again try to align it with the real cash inflows and outflows. So since depreciation is more of an accounting expense than a real expense, so we add back depreciation and remove the, or maybe subtract the capex and increase in working capital, because these are the true expenditures that are happening. So by doing so, for this company, like for example ABC, we arrive at a free cash flow to the firm as 2,950 crores. So this will be the first input that we have got for calculating the intrinsic value of a particular stock. Now, let's go to point number two, which is risk in cash flows. And we have seen in part two of the video that basically risk in cash flows. So how do we take care of risk in intrinsic valuation is by discounting the future cash flows with their respective cost of capital. So it could be either a cost of equity if you are trying to value the entire, if you're trying to value only the stock part of it or the equity part of a company, and if you're trying to value the entire enterprise, then we have to discount the cash flows with their respective cost of capital, or also called as weighted average cost of capital. So this has already been discussed in part two of this, so maybe you can check out the part two of this series of intrinsic valuation method, and we have tried to calculate wherein we have tried to calculate the weighted average cost of capital, and which has come to roughly around 13.72. So this is the input that we have already done in part two. So we'll take that as it is. And as I mentioned again, discount owner's earnings by cost of equity, and for enterprise valuation, we discount FCFF by weighted average cost of capital, right? So the third point, or the third input for calculating intrinsic value of a stock is the growth in cash flows. So basically what we are looking is that ideally the cash flows should grow in future, right? So how do we calculate, or how do we capture this growth in the cash flows? So what we do is, the first point is that we determine the reinvestment rate, and the formula is defined in the next slide. So basically what reinvestment rate is, that how much money that the company is generating is reinvesting back to the business. And why it is required? Because then only we are going to increase the cash flows. So basically this reinvestment again looked can be looked from two perspective. So again, if we are valuing the entire firm, or are we valuing just the stock part of it? So if we are valuing only the equity part of it, so we can determine the ROE of that particular, or the return on equity of that particular company. Or if we are valuing the entire stock, then we need to compare, then we need to calculate something called return on capital employed, or return on invested capital. And these have to be and these are basically required for determining how much growth in cash flows do we expect. So the formula for the growth in cash flows is again divided into two, which is growth in FCFE and growth in FCFF. So the growth in FCFE is determined by multiplying the return on equity into retention ratio. So basically this retention ratio is nothing but dividend payout ratio. We have something called dividend payout ratio. So if I minus dividend payout ratio from by 1, I'll get a retention ratio. That is how much of the how much cash or how much money from profit after tax has not been paid to the shareholders, right? So let's say if a company has a profit after tax of, let's say, 100 rupees, and it has a dividend payout ratio of, let's say, 40, so that 40% becomes a dividend payout ratio. So in that case, the retention ratio, or the money which is reinvested back to business, is nothing but 60 rupees, or 60% of that total profit after tax. So that is how we calculate the retention ratio. And if we are trying to value the enterprise, entire firm, then we can calculate the growth in FCFF by multiplying ROS or ROCE with reinvestment rate. So what exactly is this reinvestment rate? So again, I have highlighted all the key terms with yellow, so that we can just focus on that part. So for calculating the reinvestment rate, for the third point, which is third point, the reinvestment rate is nothing but how much a company is spending in its short-term assets as well as long-term assets as part of operating income, or more specifically after tax operating income. So reinvestment rate is nothing but capital expenditure, or to be more specific, net capital expenditure plus change in working capital. So what is net capital expenditure? It is the investment in for the long term. If a company has to make or if a company is setting up some new plants or factories, or it is buying some huge machineries for increase for capacity expansion and so on and so forth. So those are the long term investments that the company is doing. And if a company and we see that usually company has a lot of inventories on its books, and also those are the short term investments. So reinvestment rate is nothing but net capital expenditure plus change in working capital. That is how much from previous year there is has been, whatever the delta is there in the working capital, those are the investments that the company has made, and how much of this is a part as a part of total operating income or after tax operating income. So once we get this number, we calculate we arrive at the reinvestment rate, right? So I'll go to second point, that for calculating the growth in sorry, for calculating the growth in cash flows, we need to first determine the reinvestment rate. Formula is already we have discussed. That is amount of capital which is reinvested back into the business, which is required for growing the future cash flows, right? So how do we calculate the net capital expenditure? It is nothing but capital expenditure minus the depreciation, or the actual I mean the capital expenditure, the actual expenses, and you subtract out the accounting expenses, so that basically becomes a net capital expenditure. So in this example, what we'll do is we'll consider, but we'll try to consider FCFF, or basically we'll try to value the entire firm, and then try to value the equity part of it, right? So I'll go to the right hand side of the slide, wherein again we already discussed that these were the few parameters that we have discussed for our hypothetical company ABC, that the company has parameters like after tax operating income of, let's say, 4,000 crores, and again a depreciation which is a accounting expense, rather than being a real expense. So this is for 300 crores, and we have already calculated in the previous slides, we have already calculated how much is the free cash flow to the firm, which is nothing but rationalizing the after tax operating income with capital expenditure and increase in working capital. And in our previous part, in the part two of this video, we are taking the same example wherein the company has weighted average cost of capital as 13.72, and the market cap of the entire company is 57,000 crores, right? So if I try to calculate the FCFF of this company, so it is basically 2,950 crores, and a net capital expenditure is nothing but how much capex minus how much depreciation is already there. So it is 800 crores, and then we'll consider the reinvestment rate, which is nothing but 800 plus 250. What is 250? 250 is the increase in working capital or the investment in working capital as a percentage of after tax operating income, which roughly comes around 26%. And let's say for step two, from company's financial statements, we can arrive at the company's ROC, which is return on capital employed. So basically, how much return it is generating on the capital that the company is employing. So that is 25%. So by the formula that we discussed in the previous slide, we can determine how much growth we can expect basically in these free cash flows, or to be specific, in free cash flow to firm. So that can be calculated by multiplying rows with reinvestment rate, which is 6.5%. So what we are saying is that up to a period, let's say for 5 years or 10 years, what we expect is year on year, the free cash flow of the firm or the you know the we are expecting the growth in FCFF to the tune of 6.5%. Right. So to put it in a simplistic way, just to put it in a tabular form, so basically what we have done is we have three rows, that is after tax operating income, and how much is the reinvestment rate, which is we have discussed in the previous slide, that is how much company is spending in its short-term assets and long-term assets as part of after tax operating income, and the subtraction of these two will result in free cash flow to the firm, right? So in our current scenario, we have a current after tax operating income as 4,000 crores. So we have also calculated the growth in these free cash flows. So basically what we are doing in first row is we are calculating the we are multiplying these numbers by 6.5%, and that is nothing but the growth in free cash flows or growth in FCFF that we have seen, right? So how do we do it is 4,000 multiplied by 1.065, which is nothing but 6.5%. And out of this, so the operating, so what we are saying is after tax operating income should increase 6.5% year on year. And a part of this will be reinvested back to the business, which is 26% in this case. So year on year, in the top row, in the so after tax operating income row, what we have done is we have calculated incrementally 6.5%, and a part of this, which is 26% of that value, is getting reinvested back to the business. So how much is available for the entire firm, which is FCFF, or the free cash flow to firm, is nothing but say for example for year one it is 4260 minus 1108. So likewise, we do this for so in this example we have done it for 5 years, and we are assuming that after 5 years the company gets in a more matured way, and then we'll try to calculate the terminal value after 5 years. So that is how we calculate the we calculate the free cash flow to the firm till the required period, right? And at the last, we arrive at the terminal value concept. So basically, as I have written in the terminal value concept, that there are two ways of calculating terminal value. One is the liquidation value, and the second one is that if the company doesn't get liquidated and it goes on, in that case, we calculate it as a going concern value. So just to, I'll read it out, that liquidation value means that the firm is liquidated after the end of forecasted period, and then we can estimate the proceeds from the liquidation process and subtracting debt obligations, if any, to arrive at the terminal. So basically we are selling off the assets and we are liquidating the company, and after honoring all the debt obligations that we have, we can arrive at the terminal value of a company, right? Or if we are saying that the company doesn't get liquidated and goes on for more particular time, then in that case what we do is we try to calculate the terminal value in year n, which is, let's say in this case it will be year 5. And how do we calculate the terminal value of this? Is cash flow in year n plus 1 divided by discount rate minus perpetual growth rate. So this is basically the formula that is basically dependent upon the formula which when we try to do a discounted cash flow method. So this is how we usually arrive at this terminal value in year n. So few of the assumptions while we calculate the terminal value is that once a firm is matured, then we need to assign parameters to the firm equivalent to a mature firm, right? So we cannot. So what does this mean is basically that if a firm has in the period for which we are forecasting its cash flows, so if a firm has a beta value of, let's say, one, sorry, in the previous this thing we have seen that the firm had a beta value of more than one. So what we try to basically do is we try to assign more stable characteristics to that firm. So in this case, we'll try to assign a value of beta value of one. And what also we do is we try to increase its debt to the industry standards, right? Because we have seen that the cost of debt is much less than the cost of equity. Although we know that increasing debt has its own has its own disadvantages. That is, it can reduce the financial stability of a firm. But then if we try to marginally increase the debt, that can have a tremendous impact on the cost of capital for the entire business. Again, it depends on again, it depends on the business model as well, right? So if a firm is operating in an environment which is subjected to a lot of changes, in that case it is advisable that the firm should not resort to it should not resort to the debt part. And if a firm has stable free cash flows or consistent cash flows, then it can takes certain amount of debt on its books, which can help it to reduce its cost of capital, right? So by doing all these things, so basically what happens is the company's total cost of capital, or the WACC as we call it, it reduces to a certain extent when we try to calculate the terminal value. And so for example, what we have done is in this case we have tried to reduce the WACC by 20% by increasing debt and assigning a beta value of 1, right? And this has resulted in WACC of the company reduced by 20%. So in this case, if I try to reduce 13.72 by 20%, so we get a modified WACC for terminal period to the tune of 11%. And as per the formula that we just mentioned, we were discussing, so terminal value in the at the end of year n can be calculated by cash flow in year n plus 1 divided by discount rate minus perpetual growth rate. So we know the discount rate. We know the discount rate is nothing but the cost of capital, and that we have just discussed, that is 11%. Now to arrive at the perpetual growth rate, basically what we do is in terminal period, what we assume that no company can go on growing forever at a higher pace, or maybe at a pace which wherein we were trying to evaluate the the forecasted cash flow. So it has to be reduced, it has to be toned down, the growth rate has to be toned down. And it so ideally what we do is we try to take this growth period as the total or the growth rate at which the economy is expected to grow, right? So let's say in this case that we are foreseeing that the economy will grow by 5%. So a perpetual growth rate in this case would be 5%. And return on capital we have already seen, which is WACC is 11%. So if I try to calculate the reinvestment rate in the terminal value, so basically what it tells us that how to increase 5% year on year till till the time we try to calculate its terminal value. So how much of that should a company reinvest back into the business? So that is why we calculate the reinvestment rate, and this is to the tune of 45%. And then finally we calculate the terminal value at the at the end of year 5, which is basically the uh, cash flow in year n plus 1. And we multiply it by perpetual growth rate, and also multiply it by the reinvestment rate, and the denominator we have discount rate minus perpetual growth rate. So in this case, after plugging all the desired inputs, we get a value of 52,745. So so what we have done basically is we have tried to calculate all the four inputs which I discussed in the second slide, that what are the various inputs that we have. So we have discussed all these inputs in detail. We also tried to calculate each of these inputs, and then finally what we do is we put all these inputs in together so as to get the whole entire perspective of intrinsic value. So I'll just read it out, that discounting all the cash flows back to the present and making adjustment for any debt obligations or debt liabilities, And if a company has any cash or cash equivalents or any other liabilities on its books, so we adjust all these things. So if a company has any cash, so we add back that cash. And if a company has any some other obligations, like or maybe some other issues that it might be facing, or if it has done some sort of provisioning sort of thing, so we need to subtract, we need to ensure that those things are also getting captured. Like if a company, so if any contingent liabilities or those kind of things are there, so we also need to take care of such sort of things. So intrinsic value, how it is being done is we take the cash flows for all the 5 years, and in the fifth year, what basically we are doing is we are taking the terminal value, the cash flow at terminal year, that is year 5, and we are adding all these cash flows to the respective time, this thing, and then we are discounting it to the respective cost of capital, which was 13.72% in the previous slides that which we have discussed. So by doing all these things, so what we do is we are trying to calculate the present value of the future free cash flows by discounting back at the risk adjusted interest rates, right? So in this case, it's the intrinsic value. So mathematically, if you do it, so you will arrive at a figure of 39,940 crores. And let's say that after adjusting for, so company has some debt also, it might have some cash and cash equivalents, and it might have some other obligations also. So what basically we have done is we have tried to rationalize this number by taking care of all the obligations and things like that. So let's say that if the value comes at 35,000 crores, right? So what does this 35,000 crore mean, right? So what we do in intrinsic valuation is we calculate or we compare the current market price or the current market cap of the company with its fair value, which is nothing but fair value of equity valuation, because this is equity that we are talking about. So we are trying to compare the market cap of a company with its fair equity value, and then see if it is if there is a bargain involved in it or not. So in this case, what we can say is that current market cap is 57,000, but the intrinsic value is only 35,000 crores. So by looking at this, it looks like the company looks to be more overvalued from a value standpoint, right? And this is what intrinsic value is all about. That we calculate the intrinsic value. So you can calculate it on a per stock basis as well by dividing it by total number of shares outstanding, and arrive at the fair value of a stock and compare it with the current market price of a stock. And this is how we do it in intrinsic valuation. We look for any bargains if at all there are. And also a very important thing is we need to keep margin of safety in mind as well, right? So that is something which we should never forget about. So in the last, I'll just discuss about the few of the few of the disadvantages as well, because we have seen that it involves a lot of calculations and all. But even after that, we cannot say with 100% confidence that it makes that we'll definitely going to get a bargain, or maybe we can definitely say that either a stock is undervalued or overvalued from value standpoint. So I'll just read out the points that done prudently with all the inputs plugged into the model, even then there could be a wide difference between intrinsic value and current market value. Now why there could be still a gap? So few of the pointers are that maybe whatever the inputs we have considered, the four inputs, we might have either regarded discount rate or the equity risk premium not correctly. Or the second point could be is that we may have been more either over optimistic or pessimistic in case of cash flows, in case of growth in cash flows. So that is something which, if we have not considered correctly, then definitely this will have an impact on our intrinsic valuation calculation. And the third point, I think which is very much important over in this case, is that one of the biggest drawbacks of a CAPM model is, or the capital asset pricing model is, which is used for determining cost of equity, is that it takes price movements, so the volatility of a stock, to determine the risk in the business. Now, what it tells is that higher the risk movement in the stock, or the higher the volatility of a stock, higher the risk in the particular business. So basically what it is telling is, it is looking at the price movements of that stock in the stock market rather than looking at the fundamentals of that company. right? So, and again, it is based on the assumption that markets are efficiently pricing all the stocks in the market. So, based on efficient market hypothesis, it basically looks at only the stock prices and not at the fundamentals of a company. And and this is the one of the biggest drawbacks, and that is the reason this model draws a flag from all the seasoned investors that we have. So basically, we have seen Warren Buffett does not believe in this CAPM, and what he does is he discounts the future free cash flow, future cash flows of a future free cash flows of a company with the the risk-free rate. And the reason is that he only invests in companies wherein he is 100% sure about that the companies are more they have more consistent free cash flows, growing cash flows, and the management is good. And other apart from other qualitative factors that he considers, but while discounting, he only takes into the risk-free account, which is usually 5% or 5.5% in case of long-term government security. Then, if at all, the interest rates, as we see now, it is to the tune of 2 to 3% in US. So basically, he adds another couple of points to discount them. But then seasoned investors, they never pay attention, a lot of attention to the CAPM, because of the way beta of a stock is calculated, and then basis on that entire cost of equity, and hence weighted average cost of capital part is calculated. So they just either take the long term yield of a bond, or maybe if the interest rates are low, as I mentioned, they maybe add a couple of points, a couple of points to that to calculate the discount rate. And the fourth point is that even if all the inputs we have considered are correct, and we have selected those inputs with proper due diligence, then also there's a possibility that markets, the we may get a lot of discrepancy between the current market price and the intrinsic value or the fair price that we have arrived at. And the reason for this could be is that markets are not correctly pricing the stock, and hence, as we know, that it is imperative to have a lot of patience and see that market adjust the prices as and the gap is closed, so that we may profit and we may gain in that business. So again, it is like if intrinsic value is much higher than the current market price, so that is all value investing is all about. That if an investing, if the intrinsic value is more of a stock as compared to its current market price, then we should buy it. Definitely looking at the margin of safety in process as well. And if the intrinsic value is lower, as we have seen in our example, that if the intrinsic value is lower than the current market price, we should just ignore it and go to the next stock and analyze it, right? And last, I think very important of concept of the entire value investing is that margin of safety plays a very crucial role as far as valuation is concerned. And we know that valuation is more of an art rather than science, and hence intrinsic value is never a particular fixed value, but it is a range of values depending upon the different inputs and the sort of company that we have selected for valuation. So guys, that was all about intrinsic valuation, and with this we cover our discussion on intrinsic valuation. We have discussed, I think, in brief about how do we calculate intrinsic value, different concepts and all. So if you guys have any doubt about intrinsic valuation in any of the parts, that is, be it in part 1, part 2, or part 3, just drop me a note or drop me a comment in the comment section, and I'll be happy to help you out if you have any sort of doubts, right? Okay, guys, thank you. Thanks a lot and have a nice day.